Hello, everybody, and welcome to the Nasdaq Dorsey Wright podcast for this week. Today is Monday, April the 26th, 2021, last week of April. I'm Jay Gragnani, and here joining me this week is Jamie West. And Jamie, appreciate you joining. We've got a great conversation discussion teed up for the call, and specifically looking at active versus passive management, not only what we've seen so far in the market this year, but what the historical trends suggest about active versus passive management. And as we're recording this week being the last week in April, that also from a market perspective will wrap up at the end of this week what is historically known in the market as the seasonally strong 6-month period that begins at the beginning of November 1st, and ends at the end of April. So we will be back with you in a later podcast to discuss the implications of that. But long and short of it is that historically what we've observed in the market over time is that the vast majority and the bulk of the gains in the market over time have come during the seasonally strong 6-month period in the market. Again, that period being from November 1st through the end of April, which is also where the market adage of sell in May and go away has come from, that being the seasonally weak period in the market beginning May 1st and running through the end of October. However, with that said, today, we really wanted to focus more on this idea of active versus passive investment management, and that there's a lot of debate. There's long-standing debates, and likely will continue to be long-standing debates in terms of whether active management is better, whether passive management is better. And so today, Jamie's done a ton of work and research around this idea. And Jamie, just kind of jumping out of the gates, I mean, when you think about active portfolio management so far this year, at least through Q1, in the equity space, the markets have been on good footing, but there's been a lot of opportunity, a lot of positive opportunity for active management to do well. And so as we look at so far this year, before looking at any long-term trends, I mean, for active management, it's been a pretty good market thus far.
Yeah, that's right, Jay. And, that may be kind of surprising. You see all of the major U.S. benchmarks, showing strong returns year to date, small caps, even stronger. Most of the international benchmarks also in positive territory. So, it doesn't seem like it's a bad environment to just kind of be taking that beta exposure. But, underneath the surface, we've seen a lot of kind of changes in relative strength leadership and things like that. And that's provided an opportunity for active managers to add value through, things like sector allocation, weighting the sectors differently than the index benchmarks, and then through individual stock selection. And so despite the fact that, it's been a good quarter for taking beta exposure, we have seen, active managers add value in 2021.
That's right. And, there's certainly market environments that favor active management. There's certainly market environments that don't favor active management. But, a lot like when we talk about relative strength or momentum investing, it's the ability to identify and seek leadership trends in the marketplace. And when those trends are not intact, and when there's not a lot of trends in the market, it might be difficult to find outperformance in the market. When you get market environments where you see large dispersions of return, those are typically market environments that are very conducive to active portfolio management, or even relative strength or momentum type of investing. And when I say large dispersions, thinking about just historically the difference between the kind of the best performing sectors and the worst performing sectors is one way to look at that. And if you go back over the years, there is a pretty large dispersion typically between the best and worst performing sectors, in excess of about 30 percentage points per year. Last year in 2020, you had a massive dispersion of almost 70%, with technology being the best, up over 40%, and energy down over 30%. Even so far this year, through about 4 months of the year, so we're not even halfway through, and we're already seeing a dispersion in return between the best performing sector, which currently is still energy, up 25%, and the worst performing sector, staples, up just 3%. So you're already seeing a pretty big dispersion of 20% plus an excess return from the best performing sector right now to the worst performing sector. To kind of, as you alluded to, everything is up. All of the broad sectors are up so far this year, but there's been a lot of opportunity for active managers to identify those leadership trends, specifically on the sector front, being energy, financials, and quietly real estate is up there at the top, up double digits. There's been a lot of opportunity this year to do so. But, you kind of alluded to it earlier, Jamie, is that typically the case? I mean, do we see, especially in the large cap U.S. equity space, how have active managers fared over the years?
Yeah, you're exactly right, Jay. I mean, there is definitely environments that are more favorable to active management than to passive management. Just anecdotally, I've heard that active small cap managers had a really hard time earlier this year because GameStop and AMC and all of the short squeeze targets that made their way onto Reddit and social media, they were the best performing stocks in the indexes. And of course, your active managers, they're not going to own the stuff that everyone thinks is going to go bankrupt. So they were all kind of excluded from those rallies, and as a result, it was a very tough environment for small cap active managers. Even though the indexes were kind of going bananas. And at the same time, no one probably would fault them for, not having a lot of this stuff that, kind of everyone thought was going to go bankrupt in their portfolios. But to your point, over the long term, large cap US has been the hardest environment for active management. Not surprising. These are the most well-known, most researched companies in the world. So it really is, kind of challenging for a group of analysts and a portfolio manager to kind of come in and have a better idea of what's going on with these companies than anyone else. And as a result, you don't typically see, the S&P 500 falling in the lower quartiles of these universe rankings. So we look at the eVestment large cap US equity universe, and Q1 of 2021, the S&P 500 fell in the third quartile, so below that 50th percentile. But looking over the longer term, we can see that the S&P 500 has finished in the top two quartiles at every period that we looked at recently, which was looking at 5-year rolling returns by quarter going back to 2016. So 10 years of total history. 5 years at a time, rolling forward by quarter, and not once did the S&P 500 fall out of the top two quartiles during that period. So a very tough environment for active managers to try and beat the benchmark.
That's interesting.
Yeah, that has not been the case, in other markets. And this is kind of one of the points we try to make is, when you want to talk about active versus passive management, you can't just do it as a one size fits all approach. A lot of times when you read about this in the papers, they're only talking about large cap U.S. equity. Warren Buffett has famously bet people, that their portfolio can't outperform the S&P 500, and he's usually won that bet. But outside of the S&P 500 and the U.S. large cap space, it can be a very different story. Small cap U.S. managers have a tough environment, but have historically done better than the large cap counterparts. International developed, again, we see active managers pretty regularly outperforming their benchmarks, and then that is also the case in the emerging market equity. Although interestingly, looking at the longer term performance that we've just recently run, the last 4 or 5-year periods that are rolling forward by quarter, the emerging market benchmark actually finished in the top two quarters the top two quartiles each of the last 5 periods. And that's kind of a interesting departure from what we've seen in the past, where emerging market managers have really been able to add some value through stock picking and sector selection. And it'll be interesting to see if this is just kind of a one-off thing, or if maybe we're seeing kind of a shift in the emerging market equity space that is making it more difficult for active managers.
That's interesting. And you think about, the emerging market benchmark specifically, whether it's MSCI emerging market or any number of broad-based emerging market indexes, tend to be very heavily weighted towards China. Typically, a lot of those benchmarks are in excess of 30% of China. And so, when you get into an environment like that, where China has done very well over the past 4 or 5 years, and that's kind of the bulk of the benchmark, anything to diversify away from China in emerging markets has struggled, much in the same way that, prior to really last year, the 4 or 5 years prior to that, anything you've done to diversify away from large cap U.S. equities on the equity side has been difficult. So it's interesting that you're seeing that show up in some of the numbers on the emerging market side as well right now, with China generally over the past number of years has done well in the market.
Yeah, and there could be any potential number of causes for this. As you say, it may be that some managers have kind of tried to diversify away from China a little bit. It could be that we have so much stimulus just being pumped into the market all around the world that it's kind of rising tide lifts all ships, even the ones that are maybe leaking. So a lot of potential reasons that we could be seeing this, but definitely something it is a I think looking historically, we would have said that, emerging markets were one of the more favorable environments for active management, just because it is a less researched, area of the market. So to see this kind of show up in that space, I think is interesting.
Yeah, and it's also historically, I mentioned earlier, like the return dispersion, emerging markets, small caps as well, historically, I mentioned the dispersion in sectors, and that's really predominantly U.S. large cap. Once you get into some small cap areas, once you get into emerging markets, some of those dispersions on a year to year basis can be pretty wide. And so typically those are environments that are favorable for, active managers to go in and identify those trends, and those, whether it be from a stock level, whether it be from a sector or country level, to identify some of those leadership trends in the marketplace. So it'll be interesting to see how that shapes up through the remainder of this year and then into the coming years. And that's all, kind of equity focused. And it sounds like, a lot of the research that you've done historically within the large cap U.S. equity space, active management has been tough. Active managers have done well here, recently, certainly. But once you get into some of the other areas, emerging markets, international stocks, small caps, historically, that's where we've seen active managers really be able to earn their fee. Let's talk about other asset classes, though, outside of equities. I mean, fixed income historically has been one that has been favorable for active managers over the time. Has that been the case, this year, as well as the numbers support that?
Yes. Almost every time period, you see, the fixed income benchmarks falling in the third or fourth quartile near the bottom. So it seems that fixed income managers are having very little trouble, outperforming their benchmark and adding alpha. And part of that can be just the difference in index construction potentially. We think of indexes and we think of the S&P 500, and they are by and large some version of market cap weighted, and the fixed income indexes are also market cap weighted in a sense, except in the equity indexes you're getting the largest companies. So at least in terms of increasing their value, they've been the most successful. Apple's the largest company in the world because they've been very successful in business. In the fixed income indexes, it's just the biggest issuer. It's the companies that have issued the most debt that are weighted the most heavily, which aren't necessarily going to be the healthiest companies. They're just the most debt laden. So there are some things about fixed income index construction that may kind of favor active managers in that regard. Also they just have some things that they can do. Some relative value movements, taking on a little bit more credit risk over just the treasury risk, the interest rate risk that is really built into benchmarks like the U.S. aggregate index. So I think a lot more tools for fixed income managers to use that may help them out. But as you said, consistently seeing outperformance from fixed income managers, over the passive benchmarks. So if you're out there looking for a fund to put your client in, would definitely, start by looking at active funds in the fixed income space.
Yeah, that's great. It's really interesting too to think about. You think about the market cap weighted structure of equity indexes, obviously, and sometimes that gets overlooked in the fixed income space. So I think that's an important thing to keep in mind on the construction of some of those fixed income benchmarks. Is that the largest issuers of debt are going to end up being the bigger components and bigger pieces of the equation there in the fixed income space. So very, very interesting. Jamie, as always, extremely insightful. I mean, I think the active versus passive debate will continue to go on, but based on some of the data that you've looked at, it sounds like there's certainly place for both in investors' portfolios.
Yeah, I think that's right, Jay. I think there is definitely a time and a place for active management, and then there are some spaces where you can generally, save some expenses, and your client will be better off by going with the passive funds.
That's great. Well, Jamie, thank you again. Appreciate the insight. Appreciate you joining us on the podcast. Thank you all for joining us and listening to our discussion on active versus passive management. If there's anything that we can do to help you or your business, or you have any questions, please don't hesitate to give us a call at 804-320-8511, or you can email us at dwa@dorseywright.com. So thank you all. Look forward to talking to you soon.